I'd like to introduce now Daniel Taylor, the CEO of Bags, who's going to take us through the founder's guide of cash flow and debt financing. Daniel, take it away.
Wonderful. First of all, thank you all for spending some time with me, with us today. Thank you so much, Adrienne and the Naturally community for having me. A little bit of an introduction for myself. Actually, a couple of housekeeping items before I introduce myself. Please use the chat functionality. Feel free to introduce yourself, say, who you are, what you're building, where you're located. Context is always important. We're all founders who are trying to build something. Second, if you have questions, we'll leave a pretty significant amount of time towards the end of the presentation for questions. If you have any, feel free to raise your hand and I'll get to it right when we finish, or ask your question, within the chat. I'll keep an eye on that as questions come through. And yeah, just from a structural perspective, we're going to go through a little presentation for maybe 15 minutes or so, try to make it as engaging and insightful as possible, and then we'll open it up to questions. I'm excited to get to know each of you. Quick introduction for myself. My name is Daniel. I am the CEO and co-founder of Bags. Bags exists to solve access to specifically capital for small businesses. We've been doing this work for the last 5 years. I've helped thousands of businesses get prepared and ready to receive capital, and also really make sure that they've got all the things they need to become capital ready. We're a software platform and financial management solution as well. So, part of what we do is help you prepare for capital, but we also help you make sure that you've got the financial tools to manage that capital effectively and deploy it effectively. So I'm going to open it up into the presentation, and then again, questions, if you have any, throw it into the chat. And again, thank you so much for spending some time with me this morning. Okay, perfect. Share view. Let's go enter full screen. Perfect. I think everyone can see my screen and we will dive in. So today we're going to be talking a little about financial management and all the alternative financing landscape, importance of using your cash flow and debt financing to manage your growth. This is especially relevant in the broader consumer product space for a few reasons, which I'll talk about in a little bit. As a quick reminder, my name is DT. I run a company called Bags. We build a platform to help you manage money, borrow money, and spend money better. Before we actually talk about goals, I think, before we start talking about access to capital and financing and that whole entire landscape, we always need to start with, you, the business. And we always try to start here whenever we work with a small business because, understanding what your goals are, what type of business you're trying to build, what some of the targets you're trying to hit over the next period of time, what are things that you can do to unlock that next level of goal for you and your business. The next part is we move to, what's your financial status? Like, what do your numbers say? How do you analyze where you're at today and where you really need to go and sort of build a pathway towards that. And then the last step is, what do you need money for? The name of the game here is not getting a lump sum of money to solve all of your cash flow problems. The real name of the game here is making sure that you find the right type of capital for the right solution to unlock the next incremental level of growth for your business. Something that you'll probably hear me say multiple times throughout this presentation is, especially when we talk about the alternative financing space or sort of the financing space as a whole, it's about making sure that it's a profitable transaction, meaning you should be using and seeking capital to do what? Unlock more revenue or cash flow for your business. So again, just to repeat that, if you seek financing or you get capital, make sure the capital is utilized to unlock more revenue or more cash flow. And that is the name of the game. It's how you turn what was perceived as a liability into more assets, into more revenue, and into a solve for cash flow constraints of your business. A big part of this, the number one reason why small businesses or specifically businesses in the consumer product space get rejected for financing is financial documentation, right? Making sure that you have your core documents in place to proceed, not only increases your likelihood of getting approved. It also decreases the amount of time it takes to get approved, and will likely give you more access to capital going forward. Um, Part of the reason why this exercise is also important is because in that you might actually be able to identify opportunities to use that capital effectively, to generate more revenue, to understand your margins and where to optimize it further. And so, in terms of financial systems, these are some of the things that we recommend starting with. Building a model and understanding where your business is going so that you can really see what that capital will help unlock in terms of revenue or cash flow is key. It gives you a benchmark, a KPI, a goal on the board for you to work towards. So start by building out a model. Next, make sure that you do your books every single month. It's interesting. I think a lot of businesses, and I was that same business owner myself, think about finance as sort of a nice to have or as a thing to do. It is necessary because finance is information to make good decisions. Good financial management means you can make better decisions about your growth. And then what you're able to do once you do that on a monthly basis, or if you have a partner to help you do that, track budget versus actual, and then try reporting against KPIs, because it'll help sort of you get a benchmark of where you're at versus where you're going, how you're moving against your targets, and then potentially understand why things didn't work. Because half the battle, as any business owner will attest to, is you're going to fail. Some things won't work, but understanding why gets you closer to figuring out how to make sure that you do it right the next time. So, in quick summary, it's about setting financial targets, tracking progress, seeking capital, investing in growth, so that you can hit your goals. Like that's really what our goal is today is to try to make sure, especially the seeking capital and investing in growth part, you are aware of the options that exist within the market, what it takes to be approved, what it takes to ensure that you're using capital to solve your most pressing problems as a small business owner and as a consumer products owner. So now let's dive into the money part. So there are a couple different ways to fund and fuel the growth of your business. There's revenue, there's debt, there's equity. There's also things like crowdfunding and grants, which I'll touch on a little bit at the end. But we've found that the vast majority of businesses use revenue and debt financing in order to fuel and fund the growth of their business, right? And to be honest, the best way to fuel and fund the growth of your business is revenue first, right? Part of the reason why we start with the goal setting exercise, understanding where your opportunities are, understanding your current numbers, is starting with, let's see if there's an opportunity to generate more revenue first or increase your cash flow. If there is, pursue that before you go out and pursue any sort of financing, because again, it's the most affordable and least expensive way for you to fuel the growth of your business. Then we've got debt and equity, right? The truth of the matter is 99% of businesses who seek external capital use debt to fuel and finance the growth of their business, right? 99% of businesses use debt to fuel as external capital to fuel the growth of their business. And then there's the equity side. And the equity landscape has changed, right? Everyone's heard of venture capital. I'm sure many of you are thinking about raising various types of equity, whether that be from angel investors or from VCs, or from other players within your space. And equity is the most expensive type of capital you could take for your business. Why? Because you're giving away a piece of ownership in your business, right? Debt you can pay off over time. Equity stays with you until there is an exit event or recapitalization. So if you decide to pay out a dividend of $100 and you give 10% of your equity away, guess what? That 10% is going back to that investor, right? And so when you're thinking about the three sort of buckets and ways from least expensive to most expensive, if you're going to go out and raise equity, that's okay. Make sure you use it for the things that really drive the moat in your business, because that is expensive capital, right? Use those dollars to drive that moat. Again, not a lot of businesses raise venture, especially in the consumer product space. It's become tighter and the threshold is larger. And what's interesting is the better you can be around driving more revenue and using working capital to drive more revenue, the more likely you have the opportunity to actually receive equity funding from a potential VC or an angel investor within your space. So what exactly is this flywheel for growth? And I'll give some examples of how it actually works. The first step, as mentioned, is analyzing your finances, understanding where you're at today. Once you've done so, strengthen revenue or cash flow. If you see an opportunity to generate more revenue or cash flow, go and pursue that first. Why? Because by generating more revenue or more cash flow, guess what? It helps you secure the bag, secure that financing, and then invest it in things that do what? Drive more revenue or increase your cash flow of your business. We'll talk specifically about how to do that within a consumer products business because there's nuance in naturally how your business exists in terms of how this should work efficiently. But again, analyze your finances, generate revenue or cash flow, secure capital, and then invest it in things that generate more revenue or cash flow and run this cycle back. I think one common misconception that we see with a lot of business owners is, especially in the consumer product space, is that you need a lump sum of capital to solve all your problems day one. And what we found is this cycle, actually, especially if you're going to be doing things like inventory runs on an annual basis or likely anywhere between 2 to 3 to 5 times a year, right? You need to be running this cycle multiple times per year. It's about finding the right amount of capital for the right use case to unlock an incremental amount of revenue and cash flow growth, and then running it back. And we've built a bunch of tooling to help you do so, which I'll get to in a little bit. So a couple examples. Khadija, Dasso Beauty, an incredible founder in the personal care space, beauty business. Her case was interesting because it's not as if she didn't have access to credit. She just took on a couple different MCA financing products. Merchant cash advances, which I'll talk about what they are in a bit. They're offered from various sort of payroll providers. Shopify offers them, etc. But the problem with MCA is that you give a percentage of your revenues every single time to repay that merchant cash advance. And over time, it makes it really, really difficult for you to scale because that's your margin that you're paying back to that MCA at point of sale. So Khadija, her problem was she had a bunch of micro loans and they were eating up her revenues, which in turn made it very hard for her to what? Qualify for other forms of capital that would be healthier for her business and help her scale more quickly and more effectively. So we worked with her to refinance her out of those micro loans, out of those MCAs, so that she could go from these floating payments to fixed payments, and in turn use that excess capital to what? Drive more revenue over time. Khadija was a $250,000 to $350,000 a year business when we first met her. I think she just passed the $2 million a year threshold. Incredible founder. So now is probably the most dense part of this presentation, but I think it's important because, as I mentioned, it's about finding the right product for the right use case. And even when I got into this business, like expecting you, the business owner, to know all of these products isn't necessarily the game. The game is for you to be able to understand which products are most relevant for what you need capital for, and then making sure that you're using it in the right way that's actually advantageous to your business. So I'm going to start at the top left and work my way around. So term loans. Term loans are your more classical small business loan that are typically longer term loans, anywhere from 1 year to 10, that you repay with interest over time, right? Great thing about term loans is they're typically, fixed monthly payments. Term loans are great. They're more small business like bank loan for longer term investments in your business, meaning things that take a little bit longer to manifest in terms of revenue and cash flow for you, right? And so, think about your term loan as those things that, maybe you need to invest in something that'll take a little bit of a while to manifest in terms of revenue or cash flow. That's what your term loan is for. Sort of general all-purpose growth. Lines of credit. And don't worry, I'll follow up this slide with a little bit of a breakdown of who to get the money from. But lines of credit, think of them as a much larger, business credit card. They're often more expensive than term loans that once you sort of tap into, you repay with interest over time. One of the problems, one of the things that we most commonly see is that every single business wants $500,000 at 3% in the form of a line of credit. If you find that product, let me know because I want that product too. But the truth of the matter is that a lot of businesses end up taking on a line of credit and using it like a term loan, meaning they max out that line of credit, right? And then they pay it back like a term loan. But typically, lines of credit are more expensive than term loans, right? So if you're going to go and use a line of credit like a term loan, just get a term loan. It's always often more efficient and more capital efficient for you. Lines of credit are very, very good for things like business seasonality, cash flow crunches in certain months, and really think of them as like an incredible way to help you manage your cash flow, but use it like a credit card, pay it off, right? Don't hold a large balance on that line of credit. Moving down the right, equipment financing. Likely some of you are producing your own products. If you need to expand and purchase more equipment, you can actually, finance that equipment. Then I'm going to go left and I'm going to go down. I'm going to finish in the bottom right. Merchant cash advances. So merchant cash advances, as mentioned, are typically loans given out by fintech companies of different assortments, whether that be Shopify, Square, PayPal, payment processing providers. By the way, nothing against any of those businesses. They are all great business for their own purposes. But merchant cash advances are very often very, very expensive and can be very restrictive for your business. The thing about them is they're, pretty quick, right? You can get them in 24 hours. But when you think about the interest that you pay, right? So let's say they charge you a 15% fee that you pay up front, and then they take 20% of your revenues until you pay it back. If you amortize that over the course of the year, that 15% is a lot closer to 30 to 32% interest. That's worse than a credit card, right? So really think about merchant cash advances as your last, triple last, try to avoid at all costs resort. And if you do take one out, think about refinancing that merchant cash advance with a term loan, right? It's worth it. It'll allow you to reduce the amount that you pay on a monthly basis and pay that out over a longer term period of time. Next, venture debt. If you end up raising venture capital, you can leverage some of the venture that you've raised, the equity that you've built in the business to receive some venture debt. We often don't necessarily recommend venture debt because if you can qualify for a different product, it's often more advantageous. And then down on the right, invoice, AR, or in many of your cases, purchase order financing or factoring, right? Truth of the matter is yes, these products are more expensive when you look at it on an annualized basis, but these should not be used as annual products. These products are to help with what? The cash flow constraints of your business. There's also inventory financing, for example. Meaning, when you get a purchase order, rather than using your own credit or your own capital out of your pocket to go out and purchase the inventory and fulfill that PO, you can use the purchase order. You'll potentially lose some of that margin to get and receive financing so that you can actually fulfill that PO, right? Or that invoice or those accounts receivable. Or you can actually go out and receive inventory financing to finance that inventory as well, right? It's a really, really, if managed appropriately, it's a really, really great way for you to be able to scale your retail relationships without having to take as much capital out of pocket. Because the name of the game when you're expanding into retail is not about getting product on shelves. It's about getting your products off the shelves. It's about marketing and moving product, right? And so what often we see with a lot of businesses in the consumer product space is they get that big contract, they put all their dollars in inventory, and then there's a time between when their dollars are in inventory and when it returns to them in terms of revenue. And that time is what can potentially sink your business because you, of course, need what? Dollars for operating and for marketing, right? So again, you can use things like inventory financing, purchase order financing, in order to appropriately, scale and help manage that cash flow crunch. So types of lenders, and we've got about 5 minutes left, so stick with me here, y'all. Types of lenders, CDFIs. If you don't remember anything that I said on the entirety of this call, remember CDFIs, Community Development Financial Institutions. These are nonprofit lenders who are built to lend in small businesses in their communities, often at market or below market rates because they are nonprofit lenders. They are the most affordable place in America to get likely a small business loan, right? They also help administer things like SBA 7 loans and originate loans to the SBA. I highly recommend each of you look up CDFI in your city or state and get on the phone or shoot them an email or potentially submit an initial application in order to start to build a relationship with CDFIs in your community. They want to lend you capital, and they're great places to get a term loan for your business locally. Next are community banks. Similarly, they are also really, really great place to get term loans and potentially lines of credit for you as well. They're often hyper local, so looking up which community banks exist within your city, state, or region is important. Then there are fintech lenders, those financial institutions who offer some of the unique products that don't exist as lines of credit or term loans. Again, one of the things to keep in mind from a fintech lending perspective, if they give you money really, really fast, just make sure you read the fine print. Generally, if anyone's willing to offer you capital in less than 24 hours, it's often pretty expensive. That's the truth of it. One thing to note on the merchant cash advance side, they do file a lien on your business at UCC, which makes it very hard for you to get other types of financing. But what's great is CDFIs often will refinance you out of that merchant cash advance in order to help you clean up your balance sheet and get access to better credit. And then there are private lenders as well, who are pretty active, especially in today's market. So pros and cons of using debt. Pros of debt, it's non-dilutive, can move fast. There's cash flow flexibility. There's cash flexibility, and then it can be cheap a lot. It often is a lot cheaper than equity over time. Cons, not all loans are created equal. As mentioned, fast money is often not good money, right? Do the work to find great credit providers. That's something that you can get access to, or something that we can help you get access to at Bags, which I'll talk about in a bit. Personal credit is often considered, which I'll talk about shortly, requires financial visibility. And then, of course, you got to make sure that you repay that loan. But I'm going to say it one more time. One of the best ways to ensure that you can repay that loan is using the capital to drive more revenue and more cash flow. So making sure you use the dollars as a revenue generating activity or towards things that generate more revenue or cash flow for your business is a great way to ensure that you are accountable and can repay that debt over time. Am I ready for a loan? So typically what we look for, and as mentioned, guys, please throw your questions in the chat. I'm not looking at it right now, but I promise I will look at it in a couple of minutes right when I finish this presentation. Are you ready for a loan? Getting to a point where you're generating at least sort of $5,000 a month in revenue is a great sort of initial threshold to open up the world of credit for you. There are lenders who work with smaller businesses, of course, but we like to look at sort of that $5,000 a month mark because it shows that you have sort of a repeatable revenue generating cycle, right? It means you have control over your levers, which also means if you take on financing, you can drive those levers to what? Grow the business. Profitability after expenses. This is not mandatory, but it helps, right? Increased month-to-month cash flow is a representation that you can potentially pay off working capital. Best way to ensure that continues to happen is if you're using the dollars for things that do what? Drive more cash flow. Credit score above 600. Again, that's sort of your initial threshold to get access to most credit products. But there are often CDFIs and other lenders who work with small business owners who have a credit score that's slightly below or below 600. There are options out there in the market. And then lastly, financial documents. One of the things that I mentioned earlier is that the number one thing that we see with businesses is not that their business isn't strong. It's that their books don't represent how strong their business actually is, right? And doing things like optimizing your books from a tax perspective to show you're not making any money decreases your likelihood that you get access to good credit in the future of your business, right? So it's okay often to show that your business is actually making money because it will increase your access to good capital. These are the documents that you need up to date, and they should show things like revenue, COGS, gross profit, gross margin, especially in the consumer product space. If it is just revenue and expenses, it's not detailed enough for a lender to really understand the unit economics of the product that you're selling. So make sure that it's detailed. If you need an assessment of that, I'll talk about how Bags can help you do that shortly. Balance sheet, cash flow statement, debt schedule, and tax return. Debt schedule. If you have a loan, that's okay. If you have some credit cards, that's okay. But make sure that you've got essentially a pre-built out debt schedule as part of what you get as being a member of the Naturally community, Naturally New York community. You get access to Bags with a bunch of free tooling, including a free debt schedule builder. So look out for some more information on that shortly at the end of this. Putting the name of the creditor, the amount, the interest rate, maturity date, your monthly payment, so that you can really understand what your current liabilities look like. Debt stacking. This is extremely relevant for consumer product businesses, as I mentioned before. That sort of, strengthen revenue, analyze finance, strengthen revenue, secure capital, invest in growth, cash conversion cycle. As mentioned, this is the time it takes to turn your inventory expenses into cash flow from sales. Tightening up that cash conversion cycle is an essential action to scale a consumer products business, right? So tightening up your cash conversion cycle is essential. So here's one of the ways that we think about sort of building a debt stack, meaning multiple financing products to help you tighten up and shorten that cash conversion cycle. So purchase order financing to cover expenses needed to fill the orders, then using factors to make sure that you have that cash on hand, inventory financing, so that you aren't taking capital out of your product to do that next inventory run. Using a term loan for some of those longer term initiatives that drive revenue or cash flow, whether that be from marketing, payroll, expanding the business generally, and then lines of credit, of course, to make sure that there are short-term expenses or cash flow crunches you can meet, right? It might sound super complicated, but one of the things that we've done at Bags is try to build things to help it be a little bit easier to attain that. So things to remember, good financial management increases your likelihood of growth. There should be a direct correlation between debt financing, revenue, and cash flow growth. And then lastly, start thinking about financing before you need it. It's about being proactive, not reactive. This is especially important coming out of Black Friday, Cyber Monday, and with holiday season on the horizon, right? I'm sure all of you are so focused on having an incredible season. You know, especially the broader consumer product space, people generate anywhere between 60 to 70% of their annualized revenue within this monthly period of time. It's also a period where retailers are starting to think about budgets for next year and starting to place some of those larger POs. A lot of businesses come to us at the point where they need money. Let's say when things are slow in April or May. The goal is about being proactive. If you have a great season, now is the time to apply for financing before you need that capital because you're coming out from a position of strength. And by having good financial management and insights, you might know that you're already going to have a slow season no matter what you do in April or May. So be proactive, get ahead of it, get capital before you need that capital. And then lastly, from a bags perspective, two gifts for you guys today. We do a lot of things at Bags. We really are trying to build a financial growth engine built to power you to be better with your money. And so, we provide bookkeeping and accounting services to make sure that you always have the books that are necessary. We built tooling to give you CFO level reporting. And then we've got sort of a curated set of debt options, as mentioned, to help you understand what credit options you're available for. We've got 60 lenders built out, 60 available lenders on our platform across the wide array of different use case. And then we've built you tooling to help manage that debt. Each of you, by participating on this call, will get access to our bag software for a period of 3 months. Every single one of you will also get a free financial document review to see whether your books are up to date, what needs to be changed, how to fix it as well, so that you can go back to your current bookkeeper, or even if it's you and you do it yourself, to make some of those changes to make sure that you're really ready to receive credit and your books can get in order. You also get a free custom debt strategy for your business, where we'll break down which debt options work best for you, how to use that debt appropriately, and then understand what your current available credit could really look like. Because at the end of the day, if you're able to run this cycle, you can hopefully tap into the things that can continue to fund and fuel the growth of your business. And then lastly, if you want to book a call with myself or my team and just chat and see how we can be helpful, we're here for it. We started a business to help businesses like yours grow. It's what we do all day long. Trust me, there isn't a scary or a case that we haven't seen yet. And we're not magicians, but we're honest, hardworking team who really understand this credit space and financial management. Let me pause here and let's open it up to questions. Sweet. If anyone has questions would like to even present it themselves, feel free to raise your hand. If not, I will start to answer any questions in the chat.
Dom from Mighty Meats said, thanks for the presentation. So many mindset shifts. I currently use QuickBooks, but the UX is tough. How might bags fit into the financial stack?
Really, really great question. We're built on top of QuickBooks. So our goal is not to get you off QuickBooks. I know it's a great platform built for accountants and not built for small businesses. And also you should keep ownership over your financial data. Like that shouldn't be the thing that we own. So we built Bags right on top of QuickBooks. So all you need to do is log into Bags, use link your QuickBooks, and you'll get all the financial insights, access to credit, and all those other things. So good thing is we found most businesses use QuickBooks. So hopefully that's helpful.
Anyone else like to unmute themselves? Ask Daniel a question. Don't be shy. He's here to help
Hey,
advise.
Daniel. Thank you so much. This is Dom from Mighty Moose. I can turn my camera on too. I hope you can see me. Hi. Think this was a great talk. I really like I had a couple mindset shifts that you touched on. In particular, I've heard stories that say like, oh, on business, it's good to show that you are not making money or you lost money so that you could avoid taxes. And it feels like that always felt kind of like a fear-based mindset, like
Yeah.
be afraid of the IRS, like show that you're not as successful as you are. So I'm looking forward to kind of like learning more about like um having your numbers represent the truth and then like you said, use that to get debt. So I just want to name that and say thanks.
Absolutely. And to be honest, it was a mindset for myself when building this business as well, right? Because I think talk about some of the loudest voices in the room. There are a lot of players, partners, etc., who are saying, "Hey, here's how to, avoid paying any tax and how to minimize it and how to show that your business isn't generating revenue." Um, but it's the amount of businesses. Just to give you an example, there's a business that we worked with for a couple of years now who's going through an acquisition, and that business should be worth $4 million. That business is getting acquired for 1.7. And the reason why is because they had a, CPA who optimized their books is to show they were essentially not making money. And so even though fundamentally the business actually was really healthy and making more capital, their tax return showed that they didn't. And it's really, really hard to argue with a lender or an investor or an acquirer when, the thing that you submitted to the government says you didn't make any money, even if you did, right? And so again, it's okay to do the things that give you the broader, honest bookkeeping and tax write-offs where necessary. Um, but it is also a good thing to show that your business is potentially making money, especially when it is, because that will open up more doors to opportunity for you, especially because it's giving you the paper trail that you need in order to be successful. Thanks, Dom.
Yes, thanks, Dom. Anyone else have a question for Daniel?
One thing that I will share, I'll just put a link in the chat just in terms of how you guys can get free access to bags. Right here, just, and there's no critical, like, here you go. Free access to bags, and then use the code naturally bags 3 months, and you get free access to bags for the next 3 months, especially if you're thinking about credit and curious and see what you can qualify for, or even just want to get an understanding of your current books and how to make them better and really how to make them useful, including all the other tooling and bells and whistles that we've built out. Give it a try. It's kind of our gift to you, and because we think every single business should have access to this information.
Thank you. I have one question. So you mentioned kind of that fundraising you don't think is a really great option in the beginning. Under what circumstances does it make sense? And what do you have any pointers or what to definitely keep in mind when you actually raise funds or get investment?
Without a doubt. Thank you for that question. So, um, to be clear, Bags is not an anti don't raise equity business, right? There is a good time to raise equity for your business, and especially if when you think about sort of the two archetypes of individuals you could raise capital from, right? There are private individuals and angel investors, or even just, individuals that you might know, whether that be family, friends, relationships, other, and then there's sort of the venture capital route. And raising equity can be a really good thing, especially in your early days, if you're building things out or you need to, build something that you need to invest capital in the moats of your business, whether that be the brand or the infrastructure, or
Mm-hmm.
really things that can help sort of build the guardrails around what you're building. Um,
Mm-hmm.
But I think where, especially in today's threshold, we think about pre-seed or seed, um, pre-seed or seed stage businesses. I think the threshold for what it takes to raise venture now in that space has gotten to be much larger, right? You're seeing seed stage businesses, the consumer product space, like, with couple to a few $1 million a year in revenue, right? Which means you've got a lot of work to do in order to get to that point. And hence why, our always our initial recommendation in order to help you get access to investment capital is figure out the right ways to start generating some generating revenue. One piece of advice I would say, especially around thinking about going out to raise capital on you know, getting your books in order is key. Investors don't necessarily want to see that you're going to use the capital for inventory or marketing spend, which is ironic because that's probably where you need a lot of capital for, which is completely normal in the consumer product space. So having a good understanding of credit can actually help you for the purposes of inventory and marketing spend, can help you actually access more equity because they want to make sure those dollars are used for the things that really drive um, um, like the moat around the business. And then showing that you know how to use working capital with equity is like sort of the holy grail that they're looking for. So yeah, drive more revenue earlier, and then make sure if you are going to go out and do an equity fundraise, give yourself more time than you think. It's the days of going into market, 30 days of prep, 30 days of raise, 10 days of close. I wouldn't necessarily say are over, but I'd say they're much harder. Um, yeah.
Hmm.
So
So,
go ahead.
no, go ahead, please. So,
No, no,
um,
I was just gonna say, I think from a timing perspective, like a
mm,
fundraise is at a minimum 6 month worth of a process.
mhm.
That's the time I would give yourself.
Thank you. And if you're saying they're not looking to invest into inventory and marketing, but more into things that drive the moat, can you like be a little bit more specific what they're
Yeah,
looking for?
definitely future product
Hmm.
development.
Hmm.
It can be things like increasing, growing the team. Um, um, It can also be around, future brand development. And I say inventory and marketing spend is in partly because when there was much more venture capital in the consumer product space, and a lot of businesses grew very, very fast when venture was cheaper, aka easier to raise.
Hmm.
The problem became none of those businesses, from a fundamentals perspective, like were ever forced to do the exercise to become like leaner, profitable businesses because they were able to raise so much money.
Hmm.
Now, because it's harder to raise for LPs, for investors to raise money from other investors in order to invest in consumer products, they really want to make sure that their dollars are being used around the business to build out the moat. And then, more of like we work with a lot of consumer products venture capital firms to work with their portfolio to get access to good credit so that, they can use other dollars for inventory and marketing spend, right? So even
Right.
if you need money for inventory and marketing, and a VC is like, "Hey, I'm ready to go, and I love your business." Like you could say, "Hey, I'm going to use your dollars for." Dom, good question. I'll get to that in a second. I'm going to use your dollars for real business growth, hiring a couple key team members, expanding my retail relationships, putting together and advancing a new product line and the R&D that needs to go into that. Um, uh, and I'm not going to use your dollars for this new, to sit into inventory because for them, they've seen too many times businesses who've gotten a bunch of venture, bought $2 million of inventory, had no money to spend on marketing, and then the business ends up going out of business.
Very well explained. Thank you.
Thank you. And really important questions. I appreciate you bringing it up.
Hey, Daniel, I have
Dom,
a few more over here.
please. Yep,
All right.
absolutely.
We have a question from Rosemary. She's a pre-revenue and has maxed out her personal funding and friends and family round. What's your advice for pre-seed and initial funding?
Absolutely. So your pre-revenue, max out your initial. So And Rosemary, if you wouldn't mind sharing a little bit more, where are you at within your product development cycle?
Yeah, thanks, Daniel, for taking my question. I am currently at the MVP stage, so I'm ready to go to a manufacturer with the design, but I need funding.
Oh, no, of course. So that's one of the so and I can speak best to sort of the like how I would go about it from a the credit space perspective, but of course every business is situational in that sense. Um, and also it's worth mentioning like to the point of personal funding and we looked at the data for a lot of the earlier stage businesses, and so many businesses start on personal credit cards or initial family friends dollars or wherever they can get the initial capital. So I hear you on the grind. Um, there are a couple products that exist that are for specifically pre-revenue businesses. One nuance there, though, is that they often require another form of whether that be personal guarantee or real estate as collateral, and like, which is a decision that each business owner needs to think through, understand whether they have or understand where they want to do. Um, uh, the other thing that we've seen sort of earlier stage businesses is seeing what you can do from a drive from a sales perspective, especially with an MVP. Like if you can get an initial PO, that's what you can go out and leverage to receive some capital to go do the first inventory run to fill it, if that makes sense. But the last thing that I would mention is yes, there are individuals and angels and different groups who are interested in, investing in earlier stage pre-seed businesses. I will say it's definitely a harder, just to be honest, like there are
Yeah,
harder days out there, as I'm sure you're navigating right now in the pre-seed landscape. Um, because I think everyone's kind of de-risking and going a little bit later, even though they're saying they're pre-seed, and then you're like, wait a second, you said you're pre-seed, but you want to see $500,000 in revenue and 2 retail contracts, right?
right.
So it's definitely harder. So I hear you.
Yeah. Well, thank you. Appreciate it.
Mm.
Thank you.
I have another question that's pretty similar. And I don't know if that's your area of expertise, but I'm also in a stage where I'm considering to do a pre-seed round, and um, I wonder how to measure the if how to measure the investment and how much like what's a good um ballpark to say, okay, how much should I raise? How many percent of the business should I give away? Under which conditions? What
Really
would
good questions.
actually, yeah, what are my points to bring across in order to get more capital for less percentage of the business?
So it's
Mm.
okay. So as a general rule of thumb, the amount that you give up per raise should hopefully decrease over time. Like that's the first piece. And the initial threshold, if I were to say average, each round expect to, give up on the lowest side 13%, on the higher side 25%. Um, and then as you go on, right, there's dilution across the board. And it's not as if you're stacking 20% on 20% on 20%. It's like 20% on, 15%, which dilutes down to 10, et cetera. What I've seen a lot of business owners, and by the way, I've done this myself, which makes and it's a hard like habit to break, or like just like gut thing to break, is like, all right, I'm gonna raise my first round at, $500,000 at a $6 million valuation, right? And because I only want to give up X% of the business. Um, uh, and that sounds good and that sounds great and all. I think what's happened is valuations have come down. And what I say to earlier stage businesses is, especially in the early days, it's about the terms of the investment outside of valuation that really matter in those early days. Like, don't get me wrong, the percentage does matter. Like, you shouldn't be giving up 30, 40, 50% of your business for $500,000 to start. Um, uh, but like doing it on a safe note initially, thinking about what the minimum amount of capital that you need is, whilst backing into a valuation that you can really think about as both justifiable and or reasonable, right? Like, and in the early days, it's, you want to be able to say to your investors, hey, there's a pretty high likelihood that with your capital, I can get to this amount of revenue, right? So the worst case from a business perspective is great. We make a little bit of money, the valuation's there and you get some sort of ROI over time, right?
Hmm.
So I would, in the early, call it pre-seed and seed investors on the venture side, are going to want a sort of a minimum ownership of anywhere between 12 to 15% of the business. That's just sort of more normal. I would, with every investor that you're talking to, I would lead the conversation with what do you invest in? What's your typical check size? What's your target ownership percentage? Um, um, what are the trends in the market that you'd like to see? And then what are the metrics you're looking for to make investments and at what stage? Start there. Because very quickly you'll figure out really the valuation that they're looking to invest at, the metrics that they're looking for, and whether they actually want to invest in your space and see the trend that you see. And so that's one way to sort of back into it, right? If they say, hey, I want to write $1 million check for X% of the business, you can say, okay, well, the valuation that they're looking for is Y. I will say in the consumer product space, though, I think the real argument, the thing that you're going to need to break through or the hill to climb is like showing how massive the market is, showing that you've got a real understanding of the ability to scale within that market, and then really proving that you're like the best founder in your space, aka the expert, to go execute against that. Because early days investments is it's a people game. It's a people and market game. I need to believe that the person's incredible, and I need to believe that I need to have a pre-existing belief that I like the market.
Perfect. Perfect. Thank you. So
Thank
let's
you.
say like, okay, if you have all of that convincing arguments and they're willing to invest, you said maybe like 12 to 15%, and then on the low end for 500,000, you said, and on the high end for it's so hard to get those numbers if you're like not experienced in the space to
It
understand.
is definitely hard, but I when
Yeah.
in doubt, I always start with like you know on the venture side, uh, because one of the other things is like, how quickly can you start to generate revenue and cash flow from how much money, right?
Mm-hmm.
Um, so I would back into that math of just like, hey, good dollars can get me to here. Um, but I also think part of it is, really like it's no longer just a hey, give me a round number game. It's a hey, show me what the round number is, whether it's $500,000, and then like really show me that you are going to turn that $500,000 into some really, really, really significant revenue. Um, but I think if you can find another path to raise less to drive revenue earlier, and potentially in doing so start leveraging working capital to drive that initial ROI, it will give you more leverage to be able to raise the money that you want and build the business that you want because you need their money less.
Mm-hmm.
And the truth about venture is the best way to raise venture is by not trying to raise venture, aka saying you don't need their money is exactly when they want to write you a check.
Great advice. Thank you.
Thank you for the great questions. No, great question.
Thanks, Daniel. That was super helpful as well, Zaina. Appreciate that.
Not sure if this was addressed, but I want to just raise it again. What do investors want you to see if they don't want you using funds for inventory or marketing, hiring, and team growth?
Um, if you're talking to potential, venture investors, put they want to see that you're going to use the capital to advance the things that, build a moat around the business, whether that be future brand development, product development, unique distribution channels, key team members to drive more ROI. Like that's a really, really good way to sort of articulate what you're going to use dollars for. Um, um, and you can say that you're also going to expand, your marketing initiatives and your inventory, but you're going to use the majority of capital for the core mode of the business. And then you're talking to working capital partners to help finance some of the other things. I think the strength and knowledge around how you use financing to scale your business is a net positive sign to venture capitalists because it shows to them that if you go out and raise more equity, right, you know how to also scale up, for example, retail distribution where 70% of purchases happen. You know how to scale up retail distribution without having to raise a shit ton more equity. It's a net positive thing. So yes, putting those dollars towards the mode of the business is the key. Team members, product development, unique distribution channels are core things that I think are super relevant.
Can you elaborate more on those MCA loans?
Ooh, yes, absolutely. So as a quick refresher, merchant cash advances likely if any of you have a Shopify or a Square or a PayPal account or QuickBooks offers them now, Stripe also does as well. You're going to get an offer for some amount of money once you start generating revenue. Typically, how they calculate that amount of money is a certain percentage of how much revenue you generated in the last 12 months. They'll give to you in 24 hours, right? And typically, there's not necessarily that much of a credit check. So you click 3 buttons, sign here, click submit, and the dollar's in your bank account tomorrow, less a fee. Typically, they charge a fee up front. That is not the same as an interest rate. That's a fee. It's how they get around lending laws for charging more interest because what they're doing is they're giving you a revenue advance for your dollars. Thank you, Mike, for joining. Really appreciate your time. And so the thing about and then what you do is you end up paying a certain percentage of your revenues back. That ranges anywhere between 10 to 25%. And, one might see a 10% fee, but because they're taking a percentage of your revenue back and you repay it over a period of time, that fee, when you do it on an annualized basis, can be, typically as expensive or as more expensive than a credit card. And the last thing is they file the UCC in your business, which is a senior lien, which means the entirety of your business and its assets are secured by the loan is secured by the business. And so we always like to say, merchant cash advances are, and the other last thing that I'll say is they hurt businesses that grow faster because they take a percentage of your revenue, which means if you have a great month, you're still paying that 22% back or the 10% back or that 15% of your revenues back, which means it makes it harder for you to do things better. It decreases the margin that you make on each revenue dollar, which in turn makes it very, very hard for you to scale. Last tidbit, there's a business, taco business in taco consumer products business in New York. They had 3 merchant cash advances. They were taking up 43% of their monthly revenues. They're doing multi-million dollars a year. That was the entirety of their margins. Their business almost shut down. We refinanced it. We reduced that to a term loan. We reduced that monthly payment down to a flat monthly fee of $5,500 because actually they were very creditworthy otherwise. They were able to capture now their whole entire margin back, and they were able to 2x their business just because they were able to get out merchant cash advances, right? It's a cycle that once you start, it's hard to get off. So again, think about capital before you need it. Avoid trying to take out those merchant cash advances if you can, and if you have taken one out, refinance out of it. It'll help you capture more margin.
Well, thank you everyone for all these wonderful questions and for making today's session so interactive. Thank you, Daniel, for sharing your expertise. So happy to have Bags on board again as a Naturally New York partner. So I plan to be bringing many more programming opportunities forward for our community next year. I did share some more information about the Holiday Bazaar, but a recording, Daniel's contact information, the office hours link, and promotion will all be shared via email later today, so you will not miss anything. Thank you again for your time today and for participating, and we hope to see you again soon. Have a great day.
Thanks, everybody. Appreciate it. Have a great day.
Thanks for setting it up and thanks for the great talk.
Thank you,
Thank you.
guys. Bye.